Okay, good morning and welcome to our the CRI Financial Institutions Year-End Accounting and Risk Management Update. We appreciate you all joining us today. There is CPE for our presentation today. You can get up to 2 hours of specialized knowledge. You have to stay on for the full 120-minute duration to do that. You also need to respond to at least 80% of the poll questions, and those poll questions will pop up, and we'll try to reference them so you'll know you're out there and alert you to them. But they will be non-substantive, if you will. They won't be technical questions. And also, we have a process for you getting your email certificate. So just follow follow the instructions on here, and you should be able to get your 2 hours of CPE. So today, our presenters are Chris Kane, who's the partner in charge of CRI Birmingham. He's also a financial institution subline leader. Subline meaning our financial institution practice is part of our financial services practice. And again, Chris is in our Birmingham office. Rob DeMombrin is the partner in charge of the CRI Nashville office. He also is a financial institution subline leader. And as I mentioned, he's in Nashville. And then Heather Barber, who is a partner in our Birmingham office, and she spends 100% of her time working with financial institutions. And myself, Doug Mims, I'm also a subline leader here in Atlanta. And so I'm going to kick it off and get our presentation started. So the agenda is brief, but is a full 2 hours of information. We'll talk about loan modifications. Then we'll kind of talk about what we're seeing with regard to current expected credit losses, also known as CECL. Chris will then cover customer fraud and talk about what's happening there and some ways maybe you can mitigate that risk. And Rob's going to give us the risk outlook through the lens of the regulators for now and through into next year. And then I'll come back in and talk briefly about AFS debt securities and some issues that we're seeing there with our clients. So the first subject is loan modifications. The FASB issued ASU 2022-02 as part of Topic 326, essentially in the post-implementation review of CECL, a couple things came up, and you all probably saw it, probably not framed as loan modifications, but in reference to troubled debt restructurings, or what we all call TDRs, going away. Also, there was a vintage disclosure aspect to this, which we won't cover today. We're going to focus on the TDRs going away, but essentially the headlines read, TDRs are gone. The call report instructions were not immediately changed. And so quite frankly, most folks just continued to do what they were doing, not recognizing that there were some different things that needed to be happening in terms of identification and reporting. So the loans that come into scope as loan modifications. So it's similar to TDRs. There is a disclosure aspect and there's an accounting aspect. What I'm going to talk about first is the disclosure aspect and what loans would actually come into scope as a loan modification under the new standard. So first of all, the borrower must be experiencing financial difficulty, and we'll talk about what that means in a minute. The modification needs to be one or more of the following: a principal forgiveness, an interest rate reduction, an other than insignificant payment delay. We'll talk about what that means in a minute, or a term extension. So if the borrower is not experiencing financial difficulty, it's not a loan modification. If it's not one, if the type of modification is not one of these four, it doesn't fall into the scope. It may be a loan modification, but not under this standard and for the disclosure purposes. So simply put, experiencing financial difficulty, and it's got to be one of these four. Okay, with that, you should either now or momentarily have a poll question pop up. And I will, given the nature of the poll questions, again, they're not technical in nature. Like number one says, I woke up on the wrong side of the bed kind of thing. We'll press on while you all answer that to make sure you get your CPE credits. Again, you have to answer 80% of the poll questions to get CPE. Okay. So I think no, I didn't. Okay. As it relates to financial difficulty, the guidance from legacy GAAP remains unchanged. So the following are some indicators of financial difficulty, and this is not all inclusive. It could include these. It might not. It wouldn't be limited to this, but if your step one is the borrower experiencing financial difficulty, and these are some things that you can use in your thought process in determining that. So the borrower is currently in default. The borrower is currently in bankruptcy. There's substantial doubt regarding the borrower's ability to continue as a going concern. And without modification, the borrower would not be able to go to another financial institution and get similar financing in the same structure and pricing. So those are the four things that would give indication of financial difficulty, which is question one, but they're not the only things that you could consider. So the other reference was, it's an other than insignificant payment delay. It has to meet that criteria. So what are some of those criteria? Well, first of all, that's not changed from legacy GAAP either. So here's some things to think about. The amount of restructured payments subject to the delay is insignificant relative to the unpaid balance or collateral value and will result in an insignificant shortfall. Now, what the guidance does not do is define significant, and therefore does not define insignificant. So each institution would have to define that for themselves. But essentially, if the institution determines, even if the borrower is having financial difficulty, if the delay is insignificant based on the criteria the institution's using, then it would not require disclosure. You would not have to capture the data and do the required disclosures. Another criteria is the delay in timing of the restructured payment period is insignificant relative to the frequency of the payments due, the loan's original contractual maturity date, or the loan's original expected duration. So the delay in the timing of the restructured payment period is insignificant relative to these things. If they are, then again, that means it's insignificant and would not fall subject to the disclosure requirements, because, and I'll say this a few different times and probably very repetitive, but essentially it's all about disclosure right now in everything we're talking about. If it meets the criteria as one of the four types, and it's not an insignificant delay, and the borrower is experiencing financial difficulty, then disclosures are required. I didn't pull an example disclosure in here. I'm happy to share one with you if you want to email me separately. But essentially, here's just generally what should be disclosed. So the institution must disclose the amount of commitments to lend additional funds to the borrowers for each balance sheet presented. So if you have commitments, if you've identified a loan modification that falls in scope, if it is in the scope and you have additional commitments to lend funds to that borrower, then that is part of your disclosure. There's other quantitative and qualitative information that needs to be disclosed as well. Similar they're not the same as what we have been doing, but they are similar. Loan type, classification, meaning the risk rating of the loan, the past due status of the loan, and so forth. And also the nature of the modification, which again is what we're doing now, but it only relates to loans that were modified in the previous 12 months. You don't have to keep going back. So once that period rolls off, you would not continue to have to make the disclosure about that loan. It would only be the nature of the modification piece would only be for loans that are modified in the previous 12-month period. The disclosures are robust, and what we've recommended to our clients is there is a data capture element. I don't know if we had clients who used to use checklists and so forth for identifying TDRs and going through these steps. It would not be difficult to to come up with a checklist that your folks could use. Obviously, the identification of the modification is probably going to be your lending personnel, but then it would impact your systems because you got to make sure you're getting the right data points. And ultimately, for financial and regulatory reporting, the folks who do that, the accounting folks, your controller, CFO, whomever, would need to be in the loop as well. So it's kind of it kind of takes a village to make sure that you understand the rules, you can identify a potential modification, and you can go through the process of capturing the associated data. Now, the good news is the update can be adopted prospectively. So for this was effective as of 1/1. So you can start with 2023 in your note disclosures in your financials, and follow these disclosures. Prior TDR disclosures are not required, and comparative presentation is not required in the year of adoption. So you get that. The good news is TDRs go away. You don't have to have comparative, and we're only looking at this 1 year. Now, the call report instructions, I believe, changed as of Q2. I know they changed as of Q3 because I saw those, but obviously I don't think they hold you accountable until the rules actually change and you can follow them. But the truth of the matter is most of our clients they're not modifying loans. They're not restructuring loans. They're not seeing a lot of credit quality issues right now. So it really hasn't been relevant other than the fact that you need to be prepared for it when it does happen. It hasn't happened, and it certainly hadn't been material for our clients, which we and they are thankful for. Another aspect of this, and this is an accounting question. So everything else we talked about is disclosure related. And from an accounting perspective, you do have to determine if you make a loan modification, you have to determine whether it's treated as a modification or as a new loan. And as I mentioned, it has no bearing on whether or not the modification should be disclosed, because those rules are those rules. However, it does impact the accounting treatment. So is it a mod? Is it just a modification, or is it also a new loan? And here they do give you some criteria. There's 2 tests that you can do to determine if a loan is in fact a new loan or if it is just a modified loan. So if the new loan's effective yield is at least equal to the effective yield of the original loan. So you'd have to meet that in order to be a new loan. Secondly, modifications to the original loan are considered more than minor if the present value of the cash flows of new versus old loan is 10% different than the modification is considered to be more than minor, which is a mouthful that I just rambled on. But essentially, if the present value of the cash flows of the new loan is different from the old loan by 10%, then it's considered more than minor, and it would in fact be a new loan. And if you don't meet that test, then you can certainly continue to evaluate other criteria, be they qualitative or quantitative, to determine if you think it is in fact a new loan. So that's an accounting aspect to it, and that'll have to be evaluated separately. Okay, we're to another poll question. Delay for a minute, and then we'll go. So I think that's it on loan modifications. My next slide says CECL, so I'm gonna, if I can get the slides to advance, I'm going to hand it over to Heather to cover CECL.
Thank you, Doug. All right, so before I talk about the slides, I'm going to talk about a little bit about what we're going to go through here. So CECL, this was effective for most of you January 1, 2023. So most of you are already familiar with it. For those of you that implemented in January, you had to document that in your March call report, and you addressed that initial recording of it there. So because most of you have already spent a good bit of time on CECL, we're not going to talk through the basics. We're also not going to cover the held to maturity debt securities, but just keep in mind that CECL is applicable to those as well. So what are we going to do? What we're going to do is go through some common issues, and then we're also going to go through some reminders based on what we've seen this year. So common issues. So for some of our banks, they've implemented CECL. They've picked a model, they've tested it, but they didn't update their policies. So you need to make sure that you've updated your policies. They may not be updated or aligned with interagency guidance. It could be using old terminology. It could be using incorrect accounting references. So for example, the allowance for loan and lease losses should be the allowance for credit losses. Doug was just talking about TDRs. We don't really use that terminology now either. We have different terminology. So just make sure that your policies have been updated. The bank may need a model governance policy as part of CECL. So many of our clients used to do a simple Excel calculation. Some of them are still doing a simple Excel calculation, but many are doing more complex calculations, and most of our clients are using a vendor. So you need to consider whether you have an allowance calculation model. And if you do, you need to include it in your model governance policies and procedures. Even if you think yours isn't complex and you don't need a full model governance policy, you want to pay attention to these because some of these things you should be doing regardless of what you call it, whether you call it a model governance policy or not. All right, next we're going to talk about reminders. So this is, did we skip one? Let's see. Yeah, go back one, Doug. I think you're going forward still. Yep, there we go. All right. So we're going to talk about important elements of a model governance policy just to make sure that you've considered all this. The first one is inventory, and tracking is the next one. So you should have a list of models. You should be documenting the model owner. You should be documenting the users of the outputs of the model. And you should include modeling requirements or monitoring requirements. You also should maintain documentation. You need to maintain documentation of the thought process. So the methodology that you selected and the justification for the methodology or methodologies that you chose for the allowance. You need to make sure you've documented. Validation, you need to include a description of the validation procedures. So first, especially this year, pre-production, so how you tested before you fully implemented the model. Most of our banks ran parallel models. Some of them did math testing, others got the SOC report, those types of things. You need to make sure you have that documented. And then any ongoing validation requirements, because validating isn't a one-year thing. Also, so several of you are going to be going into external audits. If your auditors haven't already asked for this, a lot of them have. A lot of them may have just asked you some questions about it, but they're going to want to know this information. They're going to want to know how you've tested it. So be prepared for that if they haven't asked for it yet. Internal controls. You should have internal controls over the allowance. Some of them could be pretty similar to what you used to have. Some of them may be different because your model is going to be significantly different. But your controls should focus on completeness and accuracy of the inputs to the model and the integrity of the calculation and model outputs. So operational monitoring, this is basically is the model functioning as it was intended. And then roles and responsibilities and oversight. You need to document who's the owner of the model, what's the responsibility of the board, what's senior management's responsibility, and then what's internal audit's responsibility. Usually internal audit is an independent party, so they're actually involved in the validation and testing of the model because that does need to be somebody independent of that model. All right. Next is qualitative factors. So I'm going to talk a little bit before we talk about the slide as a reminder. So what qualitative factors are? So qualitative factors are an estimate of what is true about the portfolio, but is not reflected in the quantitative baseline analysis. So for example, most of our clients use the weighted average remaining maturity method, the WARM method. In this method, the financial institution selects a look-back period for historical losses and then projects those losses over the lives of the existing loans in the portfolio. That historical loss rate may or may not reflect what you really expect to happen. So a look-back period, say it's the last 5 years and you've had really great 5 years, that may not reflect what you really expect in the portfolio. So the qualitative factors allow us to include adjustments in our calculations to show what has changed since the base historical loss rates over the look back period, or to make other adjustments for considerations that are not included in our base loss rates. So in order to develop accurate qualitative factors, you first need to make sure you understand the quantitative baseline, and then you can determine what qualitative factors are applicable to you. All right, so the first item on the slide is establishing benchmarks. So you need to consider benchmarking behavior, what is normal and reflected in our baseline loss ratio and what is not and might need a qualitative factor. So for example, past due criteria. So what you can do is establish a past due criteria norm. So this is our normal. Say past due over 60 days, 0.5% of loans we consider to be normal. We're not going to have a qualitative factor for that. But if it goes over that, if it goes over 0.5% of loans that are 60 days past due, we might establish a Q factor, or we might have a pre-planned Q factor that we're going to put in place if it meets that criteria. So you want to look at your data to determine what's appropriate and then develop benchmarks. You want to avoid duplicate factors for the same issue, so don't double dip. So another example, if you have losses reflected in the loss rate already, you don't need to add additional qualitative factors for losses. Or another one, some CECL models use credit scores to calculate the loss rate. You wouldn't also want to include a credit factor, qualitative factor, because you're going to be doubling up on that. You want to monitor for directional consistency. So don't reduce the qualitative factor for the volume and severity of past dues. If past dues have increased dramatically, that just doesn't make sense. One way to make sure that you're being consistent is to track your qualitative factors over time. So include your Q factors and document them over a period of time, quarterly, and then annually, just kind of to compare them and make sure that you're being consistent. Document with adequate details and rationale. So you need to be able to support first why the Q factors that you're selecting aren't already captured in the historical loss or the base loss rate. And then also you need to be able to support the qualitative factors with quantitative data where that's available. I will also remind you on this, your auditors, if they haven't already, they're going to be asking about your Q factors. They're going to be asking about where those numbers came from, how you develop that judgment call. All right, next slide. All right, this one is about the documentation and identification of key decisions and elections and assumptions. So there were a lot of different models you could have picked from. There's the WARM, there's the vintage, there's the discounted cash flows, and there's also the scale for some banks. I don't know what model you picked in our audience, but those are decisions and elections that you could have made. So which method did you choose? Why did you select it? And then also the historical time frame, your look back period, those are decisions, elections that you made. As far as assumptions, so you would have decided for your assumptions, can you use internal data? Do you use peer data? And going back to the WARM as our example, loan prepayment speed is a key assumption. How did you come up with your loan prepayment speed? Some banks are calculating internal speeds. Some ALM vendors have that data and are working with the banks to get it to them for their model. So make sure you've thought it through and you understand your critical assumptions. The role of governance and executive management. This kind of goes back to the policy. Make sure responsibilities from the model are clear. In the prior slide, we talked about the owner, the board, senior management, and internal audit. All right, next, unfunded commitments. So if it's not unconditionally cancelable by the bank, unfunded commitments need to be considered. You may need a reserve for those unfunded commitments. For example, credit cards usually are unconditionally cancelable, but you at the bank would have needed to go through and make sure you understand which commitments are and are not unconditionally cancelable. One that usually is not unconditionally cancelable and usually has the biggest impact are construction loans. So think about the types of commitments that the banks has, and then make sure you've considered whether a loss estimate is necessary. So if one is necessary, you're going to need to determine the funding likelihood, which is usually a factor. And again, for construction loans, those are usually going to be fully funded. Other loans may be not fully funded. They may have a lower funding rate. So those factors are going to be different. And then one thing that you can do is, again, for construction loans, so they're going to be pretty much the same as the construction loans in your portfolio. So you can take that same CECL loss rate as you had in the portfolio segment, and you can use that for your construction loans, your unfunded commitments. And you could also use those same qualitative factors if it's appropriate. So just make sure that it's appropriate to do that, and you can use that same information. All right, vendor due diligence. So I mentioned it earlier, but most of our financial institutions have used vendors. All right, so if you're using a vendor, make sure to follow your vendor management policy requirements. So that's the first thing. Also, when you're using a vendor, the bank is still responsible for making sure that that model provides accurate and complete reporting. So some of the ways that we do that, these are vendor due diligence considerations related to that. We look at SOC reports. I've seen a lot of SOC reports for the CECL models. These provide information about third-party testing of controls related to the software that you're using. We've also seen some certifications where a third party comes in and tests the validity of the calculations. And then you also can rely on your experience or that vendor's experience. So for CECL, there were some vendors that had been doing the allowance model for a long time. They obviously have a lot more experience. Some of our clients had historic experience with them and were comfortable with them. There's a lot of new vendors that were out there too, and it's okay to use them. You just need to make sure you're comfortable that that model that they're giving you is complete and accurate and provides accurate calculations. Model validation. So a model validation, the purpose of a model validation is an evaluation of conceptual soundness of the model. Essentially, does the model work? Then you want to review model performance. Did the model perform how you expected it to? Was it more difficult to use? Does the model have the functionality or options that you need in order to calculate an accurate allowance? You would have been doing this as part of your pre-testing, but you'll also be doing this, periodically to make sure it still fits your needs. I do know that some of our banks had more complexity in their portfolio than what they originally thought. So those banks would have had issues with the very non-complex call report driven models. They don't have enough inputs for them. We also had the opposite, where some banks had more complex models and decided that they didn't need them. Consideration of results. Were the results what you expected? If not, why? Was it the assumptions? Was it something else? The appropriateness of the model. Is this still the right model for us? And then a conclusion about the model's fitness for the designed purpose. So both of these go together. Is it appropriate? And do we still want to use it for this purpose? Consider changing vendors if you decide the model isn't appropriate. We have multiple clients who actually switched in the middle of their CECL implementation because they realized that it wasn't the model that they should be using. This is a normal process. It's not anything unusual. We're not used to it because we've been using the same thing for years and years, but you do want to make sure that you're considering this periodically. Consideration of the appropriateness of the model is an ongoing process, so just keep that in mind. All right, so there's not a lot on this slide. Regulatory approach and expectations is to be determined. We have not really seen a whole lot at Birmingham that I know of. I know that examiners were already asking questions prior to this year, so they may have already answered a lot of their questions. The one question that I know that we saw this year was some back and forth on the qualitative factors where the examiners either didn't agree or didn't see support for qualitative factors. That's the one thing that I know that I've seen. And if Doug or Chris or Rob, if y'all have seen anything, feel free to let us all know. Let's see.
Yeah, Heather, I would just say we went, Chris and I went to the AICPA banking conference, and there was, I guess, all the regulators spoke to CECL, all the chief accountants from each regulatory body, and they acknowledged that CECL's a work in process and that it is a work in process for their examiners in terms of their level of knowledge and training and that sort of thing. So I think they view it as a work in process. So hopefully they will on their end. So hopefully that'll translate to the same view as they're examining our banking clients and our listeners.
Okay. And if anybody in the class wants to add something, I think you can add to the comments and let us know what has happened at your financial institution. All right, so next we have a poll question. And then after this question, Chris Kane is up and he's going to talk about fraud. So thank y'all very much.
Thanks, Heather, so much. So good day, everyone. We're going to talk about customer fraud. And, financial institutions have been experiencing high levels of customer fraud for really the past 12 months, particularly the last 3 to 6 months. So in my presentation, what I want to do is first talk about some stats, because I think these stats are pretty mind-blowing because they're so significant. We're going to talk about what are some common frauds, scams that bank customers are experiencing. And then we're going to talk about maybe some practical tips and ways for financial institutions to respond to some of those common scams. So I want to give you some practical ways from this section to deal with it. So according to the Federal Trade Commission data, and this is for 2022, customers reported losing almost $8.8 billion to fraud. And those losses were more than a 30% increase over the previous year. And then investment scams accounted for more than $3.8 billion. And this amount is more than double the amount that was reported in 2021. So $2.6 billion of losses reported in 22 were due to imposter scams. So these stats aren't out for 2023. However, many people are speculating that these will be even higher for 2023. So when those come out, we can share those with you and look at that compared to 2022. So let's talk about some of the common scams that are targeting financial institution customers. And this is not a complete list, but some of the more prevalent ones. And in talking with financial institution executives, the most prevalent one is check fraud. So we're going to spend some time kind of diving into check fraud, what's happening there, what are some ways to deal with that. Zelle schemes or Cash App schemes are very common as well. Money transfer apps. So we're going to go through the Zelle schemes, government imposter, romance. This can be even long distance romance situations. We're going to talk about those and the potential fraud circumstances with those. We're going to talk about debt collection, fraudulent job offers, lottery, overpayment, jury duty, That was one that was kind of prevalent in the Birmingham area a year or so ago, but haven't seen that as much. And then there are many, many others. So these are the ones that we're going to focus on. And I think it's really important to note to really train financial institution employees as well as training customers so they can identify these scams and be on the lookout for them. So let's talk a little bit about check fraud. So as I mentioned earlier, check fraud is becoming really, really prevalent in financial institutions, community banks. Stolen checks are obtained from customer mailboxes and post offices. I know I've read a number of articles where they've mentioned checks being stolen from mailboxes and post offices. And then one article that I put on this slide that I think is excellent is check fraud has gotten so rampant that postal officials are warning Americans to avoid mailing checks. And this article was by Ken Sweet and the Associated Press from June the 13th of 2023. And if you haven't read that article, I would really encourage you to do so because it's an easy read and has some good information for financial institution folks. So recently I was talking with an investment banker about check fraud, and he commented that post offices were sealing or removing those blue mail receptacles outside post offices in many cities when he was traveling as an investment banker because people were going and stealing those checks from those boxes. So check theft is very rampant and something that folks are having to deal with. So, you know, I was getting so many bank executives asking me about check fraud that I started doing my own research and really learned that most stolen checks are sold on the dark web. And one industry group estimated that more than 10,000, I'm going to say that again, more than 10,000 stolen checks were listed on the dark web each month. So, you know, I think bank executives were wondering, well, how are these, once these checks are stolen, how are they circulated and how do people get their hands on them? And my research has concluded that it's the dark web is the way in which that's happening, in which that is most prevalent. So some more things to consider with regard to check fraud is check washing. So checks are washed in chemicals to remove the ink. These chemicals are widely available on the internet. And what the fraudsters are doing is they're removing payee names and amounts. And then those are changed after the checks are washed. So that's the process for kind of check washing, and how the fraudster is able to change the check is with those chemicals. So then Zelle fraud, and talk about some of the Zelle fraud scenarios. There are lots of cash apps out there. Most commonly we see where the customer was tricked into giving some online banking credentials to the fraudster, which allowed the scammer to enroll the customer in Zelle or some other cash app and to do the transaction so it would appear that the customer did it. So again, it's important to remind financial institution customers to never give their online banking credentials out to anyone because it could be used in an improper manner. So the next fraud I wanted to talk about is this government imposter frauds. These are schemes that are often started with a phone call, an email, or a text. It might be a letter from a supposedly government agency. What are they asking for the person to do? They're asking to require some kind of upfront payment or personal information, such as a social security number. They may ask for bank account information as well. So again, important, we can't say this enough to remind customers that providing personal information can be used to commit fraud or identity theft. Also, a reminder here that federal government agencies generally will not ask consumers to send money or to wire for payment. So those are some things to think about with regard to government imposter scams. And I'm going to give some practical tips on how to educate customers later in the presentation. So in talking with financial institution employees, this romance scam is one that they see commonly. I know we hear a lot about it where the customer gives out their routing and account number because the love interest needs someone else to send money to the customer via either wire or ACH. Then the customer is supposed to send it to the love interest or to another third party. So lots of romance scams out there. And we'll talk a bit more about those and some practical ways to deal with that. So the next one is debt collection scams. This is where fraudsters pose as debt collectors or law enforcement officials attempting to collect a debt. Really, these are debts that the customers do not really owe. So what are some red flags here? What are some signs that, hey, it may be suspicious? The caller will not provide written proof of the debt. What the situation in which threats are made or threats for arrest or some level of violence for not paying. And then, what should the customer do here? Hang up and call the agency back on the official phone number. So that's some good advice there for customers. So what's another kind of scam that folks are seeing is fraudulent job offers. So here's where criminals pose online or in classifieds enticing opportunities such as working from home or fake offers of a part-time job such as mystery shoppers. I've seen the mystery shoppers quite a bit when I look at things on the internet. So what are some potential warning signs for customers? Being required to pay money in advance to help secure the job, being asked to provide a great deal of personal financial information. Those are things that would normally be required as part of that process early on. So that's indications that maybe that's a fraudulent job offer. So the next one I wanted to talk about is lottery scams. Everyone would like to win the lottery, obviously, and that's a way that scammers will use to contact customers saying they've won the lottery or there's some kind of prize winnings or sweepstakes. Just a reminder, typically these are lotteries that the customers have not even entered. So here's an example. A scammer sent a letter to a person using falsified FBI and FDIC letterhead, telling them that they won a well-known lottery and they need to send money by wire transfer to a lottery official to secure the winning. So just because there's some kind of letter on letterhead, people still need to be skeptical of lottery scams. So the next one is overpayment scams. And this is where target online vendors and sellers, and the scammer will pose as a buyer and then send the consumer or the customer a check, a money order, some kind of proof of payment that was for more than the purchase price. And then the scammer tells the customer to refund the difference through a wire transfer. And, the original payment was fraudulent. So that's a overpayment scam. You see those typically maybe over holidays or during holiday periods. So that's something to be aware of with the overpayment scams. And then kind of last on our list as far as scams is jury duty scams. As I mentioned earlier, this is one that we saw in the Birmingham area where thieves were making phone calls pretending to be some kind of law enforcement official warning innocent people that they had failed to appear for jury duty. and then they threatened some kind of arrest unless a fine was paid, and that fine needed to be paid immediately. So, warning signs again are a sense of urgency and something that needs to be done immediately. So, also to pay, the caller asks for debit account and PIN information, allowing the perpetrator to create a fake debit card and to remove funds from the account. So again, these are some prevalent scams that we've seen, that we've heard from our financial institution customers, and we're really wanting to outline those so you can educate your employees so they can be aware of those, and then also educate and train your customers to be aware. So that's kind of the scam section. And then I think the next slide, we're going to have a poll question. So hopefully you're still awake, and give you a few seconds to respond to this poll question number 4. And just a reminder, you need to respond to the poll questions to get CPE credit. So just another few seconds there for that poll question. Okay, so let's talk about some fraud prevention and detection tips. So we've talked about fraud statistics. We've talked about some common fraud scams. Now we're going to get into the practical part of the presentation, and I'm hopefully going to give you some good ideas, some things that you can take back to your financial institution, maybe things that you're not doing currently that you can add to hopefully get ahead of this fraud, because fraudsters are getting more sophisticated and more complex. So the first one is to monitor the dark web. And what are some potential benefits of a financial institution monitoring the dark web? The first one is to prevent check fraud by identifying checks that have been manipulated and are listed for sale. So again, that buys valuable time for the financial institution if they get knowledge that certain checks are out on the dark web for sale for that institution. Also, some really great information as part of that monitoring of the dark web is to discover employee credentials that may have been compromised. So, it would be excellent for a financial institution to know if an employee's credentials were listed for sale on the dark web. It would be information that they could use to see if they maybe had a more pervasive breach, and give them valuable information if employee credentials were listed out on the dark web. So also some information that would be gathered is third and fourth parties that may have been targeted. So this is vendors or vendors of vendors. So third and fourth parties, that information would be out on the dark web and would give the financial institution knowledge about those breaches and can allow the institution time to research and to investigate those further. And then all of these things could help detect signs of a bank's internal system compromise. So here I wanted to kind of talk about a story in particular with one of my clients that was demoing a vendor product to monitor the dark web. So this financial institution client was on this demo with this third-party vendor, and the third-party vendor was showing them how they could monitor the dark web. So my client was going through the demo, and as part of that process, they saw that they had 5 checks listed for sale out on the dark web. And those checks were ranging in amounts from $80,000 to several hundred. So those all 5 checks were presented for payment, and as the client that was demoing that product said, "Wow, this is really, really valuable information," and they did their due diligence and went through their vendor management program on the vendor and have identified hundreds of thousands of checks that were for sale on the dark web, and has given them valuable advance notice and when I talk to those bank executives, they say that the product has paid for itself really in the first 3 months. So if you're not monitoring the dark web, look for ways to do that. Look for vendors that can do that. So here's some other ways to utilize those resources: proactive early identification of check fraud, identifications of third-party vendor vulnerabilities. Obviously, vendor monitoring is an important aspect of a vendor management program, and being able to do that effectively. This is just one resource in your toolbox that could help you do that, vendor monitoring. And then last on here is details of debit cards listed before the fraud occurs. So just following up on that same story. So my client that was monitoring the dark web through that vendor demonstration, they had over 25 debit cards listed for sale on the dark web and have identified hundreds while using that product. So the first thing is to monitor the dark web. So the second practical tip is to educate bank customers. And I know I've said this several times as part of my presentation, but I think it's really important aspect to educate customers for potential scams and possible warning signs. And that's what I wanted to do through those slides, is to talk about some common red flags and some common issues. And then one thing I've had some of my clients do is obtain free Federal Trade Commission customer publications. And I want to point out the key word on this slide is free, because these are free publications. And the last time that I went out to the FTC website, there were over 85 scam publications there, and they have bookmarks. On the bookmarks are on romance scams and other common scams. So there are 85 publications. Those are really easy to order in bulk. So go to www.bulkorder.ftc.gov. And I've had several clients order these materials, and they were very impressed with the magnitude and the quality of the materials. And one client sent me an email and said they had received over 100 pounds of, yes, I said that correctly, over 100 pounds of free materials for customer education. And one way the financial institution was using those publications was as account opening to educate bank customers. So if you haven't gone out there, I would encourage you to look at that site and to look at all of those scam publications. So the next one is to, again, on education and adding information to the financial institution's website. And just to remind customers, the bank will never ask for personal information in an email or text, and to never share that information, particularly bank information, over the internet, in an email or via text. And this last one is really important during the holiday season, is to make purchases only from reputable internet sites. So also, we've seen financial institution clients provide links to additional fraud resources as part of their information on the website. So the third one is positive pay with payee verification. I know positive pay has been around for a long time. Payee verification has been around for not as long, but positive pay is something that we see a lot of our financial institution clients using, particularly to minimize check fraud. So how this process works is it's an additional process in which the clearing payee name is matched to the payee's name on the check issue file. And then payee mismatch exception is reported if the name does not match. So this gives increased security for potential fraud prevention. And I would say we heard from a lot of our financial institutions early on that they were getting a lot of false positives. And what I'm hearing from clients now is that with technology improvements in this area, there are fewer false positives. So if you've looked at this maybe before, positive pay with payee verification, and thought, oh, well, there may be too many false positives, I would encourage you to revisit it again, because the technology has improved, and it's a better product. And we see more and more financial institutions using positive pay with payee verification. So the next one, kind of practical tip in this section is Zelle fraud prevention tips. And these tools could be helpful for other cash apps as well. We've talked a lot about customer education, emails to customers. I've seen financial institutions put stuff on LinkedIn with regard to fraud prevention. We've seen clients do training webinars for employees and customers, and then just resources to remind customers to be extremely skeptical, particularly when there's a sense of urgency or secrecy, and then to evaluate limits and consider reducing them for most customers, and talk more about that on the next slide. So here's some more Zelle fraud prevention tips. So when we looked at our financial institution clients, we saw that for most of the fraud that was really happening very early on after online banking enrollment. So one thing that we've seen customers do is for new online banking enrollments, they've disabled the capability to enroll in Zelle for a specified number of days. Also for Zelle enrollments, the fraud department has really determined how long has the customer been with the bank, how long has the customer had online banking. So again, in many cases, the new account opened less than a month was subjected to the fraud. So those are some tips there. And then kind of lastly in this section, want to talk about fraud monitoring systems. And I've done a lot of self-study on fraud monitoring systems, and those getting more sophisticated, and those having artificial intelligence built into those processes. So we have a lot of clients that are looking at fraud detection monitoring systems. A lot of them have them in place already and looking to get more sophisticated ones. So, what we see is the financial institution sets up rules based on some certain criteria, and if a transaction falls within that set criteria, it's reviewed by the fraud department. So I just gave an example here. A rule could be that if a new Zelle user had a specific number of Zelle transactions with a certain period of time, it would be flagged for review. Same for dollar thresholds. So, most fraud detection monitoring systems have example rules and can guide bankers through that setup process. And I would use some caution here, though. We found that many financial institutions really have to modify those example rules from the fraud monitoring aspect that are given from the vendor, because in many cases those rules have to be stricter or tighter to identify the fraud. So I would just say, really scrutinize your fraud monitoring system, evaluate it, and maybe it's necessary to adjust or modify those set parameters or set criteria to give you more potential fraudulent situations for review. So with that, that concludes the fraud section, and hope that information was beneficial and practical to you. And with that, we have a poll question, number 5, and we're going to give you a few seconds to respond to this poll question. So thank you so much. Now I'll turn it over to Rob DeMumbrium, who's going to talk about the risk outlook.
All right, thanks, Chris. I appreciate it.
Hey, Rob, let me apologize. So we're a little bit ahead of schedule in terms of slides versus time windows. So if you would for the participants, please, ask questions, put them out there. We'll be happy to answer them, even if they're unrelated to our topics. It's free advice to maximize our time as well as give you value, because there may be some things you want to talk about that we're not talking about.
All right. Thanks, Doug. Appreciate that. And yeah, definitely as we go along through this next section, do feel free to ask questions. Make sure you put them in the chat window. We'll be happy to address them. I'm also going to put our panelists, the other folks that are on that are on from CRI, representing CRI, on the spot as well, because this is the way I've laid out this presentation is going to be in a way that they might can participate later on as well. But really what we thought we would do at this section, in this risk outlook section, was to focus on what we felt like were some of the more common, the most front of mind, top of mind risks that are affecting financial institutions right now. And not just what we think those risks are, but also what the regulatory bodies are focusing on as well. So in doing that, you're probably, when I talk about the risks individually, I'm not going to do anything to enlighten you any more than what you already know these risks are, because if you're a banker and you're on this webinar, you're living these challenges every day. And so we hear it from our clients, we hear what's going on. And while it may affect some differently than others, I know each of you are experiencing it in some way. So that part is not going to be as much to tell you something you don't already know. But what we want to do with that is then talk about what we're hearing, what we're seeing that the supervisory priorities are for the regulatory bodies in 2024, and give you some guidance on that, as well as we talk about the specific risks that we're going to focus on today, that we also talk through some mitigation strategies, things to be thinking about, practical applications of what you as financial institution staff, employees can do to help mitigate these risks that exist. Obviously, we're not going to talk about all the risks that exist within your institution. I could take up more than a whole section by myself if I did that. But we're going to talk about the ones that the regulators, the examiners are focusing on, and then go from there. And so really, the panelists, where they can participate if they feel like it, is in those mitigation strategies if they're hearing anything from their clients and want to add to what I'm already saying. So the risk you can see on this slide here, the risk that we're going to focus on today are credit risk, operational, compliance, liquidity risk. We're going to talk about those in detail. And again, we're going to talk about why we're where we are with those risks being top of mind, and then what the regulatory priorities going forward are related to those areas. And then also what are some strategies to mitigate those risks. We're also, at the end of the presentation, going to talk about some other emerging risks. So these are some add-on things just to think about as you proceed forward with your institution, and some things that are on the horizon, things that are developing that would be a good idea to start thinking about and dealing with now. So going to the next slide, we'll start off with credit risk. And so in talking about credit risk, again, as I said previously, I don't have to tell you why we're here. We are in an uncertain and changing economic environment. I listed 3 things here on the slide. Obviously, with the rising interest rate environment and the high interest rate environment, increasing debt burdens due to things just costing more, inflation and pricing pressures, default probabilities are increasing. Economic growth has slowed, which does affect borrowers' ability to repay their debt. And then the geopolitical tensions that exist are disrupting trade and supply chains, and which can also affect borrowers' financial stability. I'll say, I think some of the supply chain effects have moderated to a degree, which is a good thing, because that definitely helps in the process. I'll say, just so we're all on the level playing field, I know you all know what credit risk is, but I thought just be a good reminder as we go through some of these risks of when we talk about credit risk, what are we talking about? So I'm going to give you the regulatory definition of what credit risk is. So it's the risk to earnings or capital arising from an obligor's failure to meet the terms of any contract with the bank or otherwise fail to perform as agreed. So are they going to be able to pay us back? Are we going to get what we're owed? That's credit risk. And how are we managing that? So I'll say over the course of this year, credit risk remains a concern because of the factors that are listed on this screen. It's still top of mind. I'll say from our work with our clients that we haven't seen, it's been relatively small number of payment issues that we're seeing out there right now, at least for some of the credits we're seeing. But it's definitely going to be something that as this trend in the economy continues and these rates, the level where they are, stay elevated, that we're going to start seeing some challenges for sure. And you're probably already feeling some of that anyway. But as it stands right now, and during 2023, the CRE portfolios have been relatively performing well. Obviously, there are sectors within that portfolio that are challenged. First one to think of is office properties. Those of you that have office property loans on your books feel that pain, I'm sure, to a degree, with the change in the work structure and folks going more remote or hybrid methods versus on site, are challenging some of those loans. I think you're seeing that, as rates continue to be elevated and as the economic conditions, depending on what happened with those, there's going to be stress in the CRE portfolio. So something to think about going forward. Obviously, as clients have seen, I know mine, the growth in the CRE portfolio has moderated too as well. I'll also mention that from a consumer loan standpoint, they're increasing. Consumer debt is. You're starting to see some challenges in auto lending and in credit card lending. Those are some things that are seeing a little uptick in some problems, but something to be thinking about. Also, as we all know, the housing market, with interest rates being elevated where they are, the housing market has moderated. Prices have moderated. So just something to think about. And then as you are in that area, C&I or commercial industrial loans have generally been running pretty solid lately. So with all those things in mind, and those that I've talked about, the regulatory bodies have established priorities for 2024 that I want to mention. And primarily what I looked at through this is from the Federal Reserve and through the OCC, but if they're doing it, everybody else is too, the other regulatory bodies. So primarily this year, what we're seeing from a priority going forward into 2024 would be obviously looking at high risk loans and debt service capacity, debt service coverage capacity based on changes in the rate environment. It's going to be a priority for examiners. Concentrations, specifically within the CRE portfolios, the CECL implementation for community banks. As Heather mentioned, what that looks like, we don't know exactly. I think what Doug mentioned was very, very appropriate. That it is a work in progress. So, if there's been a good faith effort to attempt to implement the policy or the standard, I think that's a positive for sure. And then another regulatory priority going forward for 2024 is going to be the impact of real estate valuations, just with price appreciation moderating and then increasing capitalization rates. That's going to be something that's going to be at the forefront as well for examiners that come into your financial institutions. At least that's what they're saying they're going to focus on. So as we go to the next slide, we want to talk about some mitigation strategies of what can you do knowing what's out there, what the examiners are going to be looking at. Most of these you're already dealing with, I know, and are focusing on, but thought we would mention them again. I'm also going to give a shameless plug right here for a podcast that Chris Kane and I did back in early 2023 that was about credit risk management and credit risk management in an uncertain economy. So we get into a little more detail in that podcast about specific things you can do from a credit risk management standpoint. But some of the things I'll mention, they're bullet pointed here, but I'll give some additional information on those. But obviously, you need to make sure that the credit risk management practices are strengthened, they're strong, they're functioning as you expect that they are, which would include thorough and appropriate credit underwriting. Obviously, monitoring needs to be top of mind right now, and then also stress testing. So as I talk about that, or as I read that and talk through that, what does that mean? So in my mind, what we're talking about here, when we talk about underwriting, monitoring, stress testing, I think in a situation where we are right now, looking at leading and lagging indicators of how the portfolio is performing. Also looking at like policy exceptions. How many policy exceptions are we granting where borrowers are maybe now getting outside of what we would want from our policy to be a positive borrower that we're making exceptions for to get them in? How are those trending? Are there more now than normal, less? What does that look like? I'd also say technical exception monitoring. So lack of credit information, collateral information, is that trend increasing, decreasing, staying the same? It can give you some information on where we are with our credits. Also, I'd say based on the way that the valuations are going, that we reinforce the importance of appraisal reviews. That we make that something that's important, and we're not just going through the motions, because we've been in a period where we hadn't really had to worry about appraisals because the value's been there. Now spending time with those to make sure they make sense. Also, think about changing loan review scopes, potentially targeting specific portfolios that may be more at risk, whether that's a portion of the CRE portfolio, whatever that may be, mixing that up just a little bit to change what you're looking at as the environment changes. Also, stress testing, whether that be at not only the individual loan level, the borrower level, but also at the portfolio level. Those are things that can help through the process of making sure that those credit management practices remain strong. Also, maintaining adequate credit loss reserves to avoid any losses that could be coming. Heather did a good job talking through CECL and talking through those qualitative factors where we're talking about the current conditions and reasonable and supportable forecast. Are we adding into those our thoughts on where we are with our financial institution, with where the economy is and what the trends are in our portfolio? And then lastly, to diversify the loan portfolio across industries and geography to reduce exposure. That's easier said than done, and that's not something that happens overnight. But what I would say to that is maybe revisiting the loan policy to see if our mix of diversification is where we want it to be right now, and in that space. So that's what I had on credit risk. So I'm sure a lot of you out there are doing a lot of different things, and but that's the first thing I wanted to talk about, because it's always going to be front and center, and along with many other things. But and now we'll move on to the next area and look at.
Hey, Rob, so, pardon me, let me interject here on you mentioned your podcast, and we do have a request out there in the Q&A for us to share the link. But as the presenter, I can't get out of where I am and go grab it. Chris, would you mind grabbing that link out there from that podcast and putting it out in the chat?
I'm already working on it.
Okay, good. Okay, sorry to interrupt. I just wanted to get that out there. And then we do have a question about fintechs we can save for the end that's related but unrelated.
Okay, very good. All right, and so the next slide, we'll move on to operational risk. And in talking about our operational risk, I know for me, and I would say probably too for Heather, Chris, and Doug, that as we're talking with boards and talking with audit committees, if you ask them what their number one concern is, this has been my experience, it's cybersecurity. It is the hot topic still ongoing, and we've included that in the operational risk area. And so as we look at operational risk, it remains a critical risk to banks. It's going to be a focus for the regulatory bodies. So as we look at the key factors that are impacting this risk, the operational risk, obviously cyber attacks are compromising sensitive data, disrupting operation, and causing financial losses. Last week, we had another report of a third-party service provider for 60 credit unions that had a ransomware attack on a platform they're using, and they're still, as of yesterday or the previous day, they still weren't operational on that platform. So the banking industry software infrastructure, it still remains vulnerable to cyber attacks, and obviously ransomware is continuing to affect banks as well as their third-party service providers, and they're still targets. So it's critical that we mitigate that risk. Also, threat actors, they're continuing to use phishing schemes to try to gain access to remote connections, and so that's another thing that we're thinking through in that respect. Also, on the second bullet there, natural disasters, they're causing physical damage to facilities, disrupting operations, which incurs losses. Wall Street Journal article a couple of weeks ago talked about the rise in severe weather events that are happening. We also see wildfires, blizzards, all kinds of stuff going on just in the severe weather area that create problems and create risks operationally of how to deal with those when they do happen. Technology failures, disrupting critical systems, compromising critical data. What I'd say on this is what we're really talking about, what I'm focusing on more with this is on legacy systems or aging technologies that financial institutions are using that are either at the end of life and or at the end of their support stage. What are we doing with those? What kind of risk are we incurring because of that? A term that's being used quite a bit now is called tech debt risk. And that's another risk that sits out there. And what that is if you've made a decision as a financial institution, not to upgrade your current systems that need to be upgraded, or you're incurring costs to maintain the systems that you have and not upgrading, there's a cost to that. There's a cost to operate your existing technology, and there's a cost to upgrade to advanced technologies. So what is that tech debt risk that sits out there? And then one of the other things, obviously, is not knowing your customer makes the banking system more susceptible to money laundering, terrorist financing, and other illicit financial activities. Specifically, when I talk about this, I'm talking about from banking as a service products, talking about growth into new markets, new avenues for the bank, just thinking through all of those things as you go through the process of knowing your customer. So the priorities from the examiners for 2024, what they've laid out there, the regulatory bodies, are IT and cybersecurity preparedness, fintech and banking as a service activities, as well as third-party risk management. So I'm going to get into third-party risk management on the next risk, but we'll talk about it briefly here. So we'll go to the next slide. Talk about mitigation strategies that we can do here. So first and foremost, as we talk about cybersecurity, obviously we want to make sure that we enhance our risk assessment, our risk management over that area, and then the monitoring of that area, which would include cyber assessments. And I'll give another shameless plug, is that is something we do here at CRI, and I think whether it be CRI or not, it's a valuable tool that needs to be used to see what your risks are related to cyber security. Also thinking through training and continual training over this, and robust patch management programs, and then protocols over backups, incident response reporting. All that stuff needs to be considered as we're thinking through the cybersecurity infrastructure and how to protect against them. We need to make sure we're looking at our contingency plans to make sure the business can continue appropriately in the case of disruption, and how that works. How do we keep operating should these events occur? And then also ensuring that we have a good vendor management system, vendor risk management process and practices in place. Talk about that a little bit more on the next slide, but obviously conducting due diligence over that area, over those specific third parties, and making sure that they have their controls in place and security in place to protect us as well. And so I think now we have a poll question, and so that will be showing up. So that's a good one. So what is your ideal work environment? That's a good question. So give you a few seconds. Remember, you need to answer the questions to get credit for the CPE. I know you all want the CPE, so be sure that you're answering the questions. I'm sure you want to listen to us talk as well too, but I know the CPE is very important.
Yeah,
So,
Rob, you think they would have put like none, like as fourth or none of the above? I mean,
I was thinking about that, but I wasn't going to say it till you mentioned it first. I'm okay with that. All right. So we'll move on now, and we're going to get into compliance risk. So again, all of you bankers that are on this call, you know that compliance risk is going to be at the top of the list as well. So you can see I've listed some of the factors that contribute to this. Obviously, it's an evolving regulatory landscape. There's new regulations and requirements that are coming out. It seems like every other day. It's a lot to put your arms around and get your arms around to figure out what to do with it, and not only what to do with it, but to do it right. You see in number 2, they're complex. None of this stuff's really easy, and so the requirements are complex. And how do we make sure that we don't misinterpret what's going on or what we're supposed to do, and how do we make sure that we are complying and that there aren't instances of non-compliance? And also there is heightened regulatory scrutiny as well, with increasing enforcement actions. So I was thinking through this of what are the common and current compliance areas that are being focused on right now, because in the guidance I looked at, there wasn't like specific things that the regulatory bodies mentioned that they were addressing or stressing. We all know that there's a lot of them, but I mentioned these. Third-party relationship risk management. Interagency guidance was put out in June of 2023. That's something we have to comply with. There's new CRA rules. Those rules have been modernized, and so we've got those out there. Fair lending continues to be an issue. ECOA, Equal Credit Opportunity Act, is another one that's top of mind for sure. Section 1071. I probably had somebody punch the screen when I said that. That CFPB rule. That rule, and then how does it? The legality of it is being challenged right now. Of if it can even be enforced. And then one we've talked about, Chris. I think we've talked about this since we've done these things. Is on the cannabis banking rules, the Safe Banking Act. Passed the House of Representatives 7 times, can't make it through the Senate. So there's a lot of things out there that are pending. There's a lot of things out there that are new. So a lot of areas to focus on and to keep up with, to be able to handle. So we'll go to the next slide and talk about mitigating strategies for compliance risk. And so as we look at that screen, thank you, Doug. As we go through those mitigating strategies, obviously, we want to have in our institutions a strong compliance culture that emphasizes doing the right thing and meeting the regulatory requirements and being on top of that. As I think through that, I think about the compliance management system that financial institutions have. How well has that been vetted? Has it been revisited based on all the changes that are taking place? Do there need to be tweaks to it to make it more relevant to today? But just going through that process of analyzing how effective and how efficient is our compliance management system, and having maybe another third party look at that, but going through that process to make sure it's strong. I'll also mention here, as specifically related to the third party relationships interagency guidance, that as we think through that process and going through what we need to there, risk assessment obviously is key of those relationships. thorough due diligence over those third-party service providers. And then contract structuring needs to be appropriate where it considers security and performance of the third party, and then consistent oversight and monitoring of those third-party service providers. I'll also mention here, not only do you need to be concerned about third-party service providers, but you also need to be concerned about fourth-party service providers, which are also very important to get a holistic view of what your risks are related to a relationship with a third party. Fourth party service providers are those that your third party uses to do what they do. So they should be captured into this analysis as well. So something to think through there. Obviously, training, Chris talked about it, education on the fraud area, but also in the compliance area and throughout all these areas that we've talked about today. Training is key. Making sure that the staff that need to be aware of the changes, of the risk, of what's going on, that they are getting appropriate training for the rule changes. And I would say too with this, not just the person that deals directly with these changes and these compliance issues, but also throughout the institution to those that indirectly touch it as well, because there's a lot of people that touch a lot of different things in a lot of different ways, and you all know that. And so making sure all those folks are trained and are aware of what they need to do. And then also to implement a proactive compliance monitoring process to make sure that any kind of issues that exist are resolved timely. So I'll say along with that, that can be continual in-house monitoring. That should be that. It's also can be third party as well to assist in that and testing with a separate set of eyes. But just as there is an ongoing process to analyze and monitor compliance with all these new regulations and issues that are out there. So with that, we'll move on to the next risk.
Hey, Rob.
And
Hey, Rob.
yeah, go ahead,
we,
Doug.
we do have a question that
Yeah.
relates to your presentation. We had someone indicate that they understand the House was scheduled to take up 1071 Friday, but hadn't heard what happened. Any update? I did not see that. I don't know if you did or not, or if anybody else on my team did.
I did not. I have not seen the update on that, but I will be on the lookout for that for sure.
Okay.
Maybe one of our panelists can look at that really quickly and we get an answer to that before we get off the webinar, and we'll go from there.
Someone said it passed, but President Biden had indicated he will veto it.
Well, there you go. There's the answer.
Yeah, it passed.
Yeah. Okay. All right. Very good. Thank you for the questions. Appreciate them. Even if I don't know, we'll figure it out and get it to you. So keep asking. We like that. So then now we'll go to the last just specific risk that I have and that I wanted to bring to your attention. And again, one that if you've had an exam, you've had some conversations around this, I am sure. 2 years ago, we weren't even worried about this. 2 or 3 years ago, this was not a problem. We were more worried about from a liquidity standpoint is how are we going to fund our loan growth? And so we were looking for alternative sources to fund loan growth. And then we had a shift and where it became, do we have enough liquidity, short-term assets, or do we have enough short-term assets to take care of any liquidity needs that might arise? Obviously, in 2023, this became a big issue after some of the bank failures in the early part of 2023. And this is still going to continue, obviously, to be a push in 2024 as well. So listed on the screen here are some of the factors that we have that are influencing liquidity risk. Obviously, market volatility has caused some changes in asset prices and deposit flows, which has strained liquidity at times. Obviously, the valuations of securities and bond portfolios are not in a good place right now. And so those aren't really readily available to use from a liquidity source unless you want to incur a large loss. But those are kind of off the table at the moment. We have some challenging deposit mixes, rate competitions making this all difficult. just general usage of funds by customers for how expensive things are. It's just a lot of factors going into the deposit outflows, and that's really what we're talking about in the second bullet. There is those potential deposit withdrawals, which triggered by economic uncertainty, turmoil, and they can drain liquidity reserves. And then also concentrations of funding sources, which we saw in one of the bank failures this year, and that they were concentrated in a certain area, and that hurt. And so now that increases vulnerability to disruptions in those sources. So as I said it originally, a lot of our problems with liquidity were trying to fund loans previously, and now we're in a little bit of a different environment with where we are right now. Just a general observation. I know balance sheets, they're seeing more an increase in advances from FHLB borrowings, and broker deposits are coming onto the books. Not that there's anything wrong with that, but there's more of that being used as a source of funds. And then also with these funding pressures, just with the general rate environment and the competitiveness for deposits, we're seeing, obviously you all are feeling compressed net interest margin. And so that's a challenge you're also facing. So all these bring to light that this is a top of mind risk that's going to be a priority for the examiners going forward. So in 2024, what the regulatory bodies have said is their priorities are contingency funding planning, along with liquidity coverage of uninsured deposits. It's something they're going to continue to look at going forward in 2024. So we'll go to the next slide, talk about mitigation strategies there. And I'm going to go very high level here and say, maintaining adequate liquidity buffers, sufficient liquid assets for short-term obligations. One thing I would mention here is that, maybe we revisit our policies, our funding policies, and make sure that what we've established as our liquidity ratios are still appropriate for where we are today. Not saying that they're not, but it's always good to take a fresh look to see if we need to revisit those, potentially to our funding sources, to see if those need to be modified, what our exposures are there, and then also stressing our liquidity. I know you're all doing that, but maybe even stressing it more in different scenarios of what would it look like if certain deposit outflows occurred, certain funding sources dried up. What would it look like to our liquidity ratio? And then also diversifying funding sources and relying on a variety of funding sources to reduce reliance on any source. So that's always a strategy too. You can do that through multiple avenues. InterFi networks, FinTech's one of those. Brokered CDs. There's always options out there as the competition for deposits is so strong. And then also just closely monitoring liquidity needs and adjusting those strategies as market situations dictate, because they do, and going through scenario analysis, stress testing, and planning helps with this. Obviously, that contingency funding plan is important, and making sure that if you ever have need of it, that it is ready to go when the time comes, because there's no worse time to have to have to use a contingency funding plan and it's not updated and it's not ready to be used. And so that incident response is important to test that. And then also keep in mind regularly testing funding lines to make sure those are still accessible in case you need them. I would recommend that's at least done annually, but you can do that more frequently as necessary, but just ensuring that those are available if necessary. And so then moving on to the last slide that I have, I wanted to just mention briefly some other emerging risks that are out there. Last year, if you were on this webinar, you got to hear me talk about climate change. You got to hear about ESG. I talked a lot about that last time, 30 minutes, I think, and that's not going away. Obviously, the regulation right now is for banks with assets over 100 billion, but as we all know, that can tend over time to trickle down. So just keeping that at the forefront and how that's going to affect your institution, not only from physical risk, which we've already talked about, but also through transition risk as energy sources do shift. So just thinking through what that looks like, keeping up with regulations and what's going on there. And then also, which is for just about every industry right now, including the accounting industry, is artificial intelligence, so AI, and what's going to be the impact of that on community banks. Obviously, some of that's already going on through chatbot features for customer service that are there 24/7 that customers can use to get help, fraud prevention, and then automated lending and evaluation. So AI is here. It's an evolving landscape for sure, and then we need to be thinking through what the risks are of AI to our financial institutions, what those compliance challenges are going to be, and then also any ethical considerations around those as well. So definitely something that's evolving that we need to keep up with. One thing I'll also mention that I didn't put on the slide as well would be talent acquisition and retention risk. That's always something that I think we're all struggling with, is getting good talent, how to retain that talent, and especially in critical areas that is the risk area. It's very important. And what are our plans in trying to deal with that? If things don't go our way and people leave, how are we gonna succeed, get the succession there? What are we gonna do to retain those folks? So another thing, that instead of being reactive, thinking more proactively about succession planning in different areas of the financial institution, and also just generally talent and retention risk as well. So obviously, I've covered a lot of areas, and there's a lot out there. You all know that, and every day we're given something new. That's a new risk we have to think through. So just staying current and reading any kind of information you have out there, keeping current with what CRI puts out there. We have information on our website as well to keep you current. We've got a dedicated team of financial institution folks that can help you and are stand prepared to answer questions and assist in any way possible. So I thank you today for being here. We appreciate it. I'm gonna give it back to Doug now.
Hey, one thing I wanted to mention before we go on is, what we're hearing from financial institutions as far as regulatory exams is that liquidity is a significant part of the regulatory exam. We're hearing from clients as much as 70%. And then kind of across the board, what we're hearing is documentation of detailed assumptions used as part of liquidity, as well as asset liability management and interest rate risk. And we've heard that from multiple clients. So I just wanted to share that with the group, is what we're hearing from recent regulatory exams from our clients.
Yeah, I would concur with that, Chris, and go a little bit further into it and just say there's a lot of focus in interest rate risk modeling around assumptions, as Chris said, and also in how you develop the assumption. How do you identify them? How do you develop them? And stress testing. And that has been, I have a number of clients who have had not significant issues, but certainly they've had, I have multiple clients who've had regulators recommend things in their reporting in and around stress testing assumptions and really digging into that piece of it. And also with liquidity, I agree with Chris. Liquidity has been a focal point. The common theme is your scenarios. That I've had multiple clients who have been, I'll say, criticized that their scenarios were not severe enough. So it's basically, whether it's the length of time or whether it's the severity, it's basically break it now. And that's come up more than once. So I think you really need to think about, when you're looking at your liquidity analysis, are you being as stringent as you could be, and looking at the most severe scenarios, because that's definitely been part of the regulatory examination process.
And Doug, I would add to that too, that definitely doing that, but also making sure you understand what your model's producing as well, because regulators are really honing in on, do you understand the output you're getting and what impact that has on your financial institution? So, you know, in the past, it seems like, and I'm going to generalize here, but a lot of that was just, let's get it done and have an ALCO and be done with it. And we're in a different environment right now of specific questions are going to come up of really to make sure that you understand what information you're receiving. And not only do you understand what it is you're receiving, but then what are you doing and how does that impact the rest of the financial institution? So
Well,
there is a definite kick on that for sure.
I agree. And, you know, that some of that may come back to training. I mean, you know, sometimes, you know, there can be an executive management. There's a couple of folks that really have a good grasp around what you're doing and why you're doing it. And so, you know, the training aspect for the non-financial people, if you will, in management that are involved in ALCO, as well as the board members. You know, it's kind of, we always look at that as part of our audits as kind of a best practice, but I think in this environment, I think it's probably a little bit more important that you do it, and it might even rise to the level of being a you know, a deficiency if you're not training your board of directors and senior management.
Doug, I think that's an excellent point. We've heard from some of our clients that they've done board training for ALCO within the last few months because of the importance of that and the comments from regulatory exams. So I think if financial institutions aren't training board members on ALCO, they really need to be doing that.
The last thing I was saying, not to belabor this point, but you know, think about whether or not there really needs to be a good reason why you're not in the bank term loan funding program, that you've not signed up for that, and that you're not signed up for the discount window. That's what I heard from the regulators when they did training. That's the way they appear to be approaching it. And make sure for the lines that you do have, that you know what your collateral is, that you've got it, you know, appropriately identified, and that there's evidence that if you needed to pull the trigger, you could. In other words, the phrase that the regulators use is operational readiness. Make sure you're operationally ready to act on your sources if needed, and be able to demonstrate that. Another thing I would be interested to hear from you guys, though, while we're chatting, and we do have some we've got plenty of time for the last session. From a credit risk management perspective and what we're seeing, you know, I went to the GBA credit conference last week, and they had some good analysis. And one question that was asked of the state banking department, and don't quote me on this because I may be messing this up a little bit, but basically they asked, you know, scale of 1 to 10, with 10 being great, how do you feel about credit quality in Georgia banks? Something like that. And the answer was 5. Now, we wouldn't expect a regulator or even an auditor type like us to say 10 or probably even 8. But I think, you know, there's some undertones of some credit risk. Rob alluded to this in his presentation, and I actually have some slides I need to go grab and share with our group, but there was some data points that were covered in that course that talked about what real estate looked like by sector in the state of Georgia, and it drilled down in markets, and of course it covered Atlanta, but it also looked at Savannah and, you know, some of the other markets, and there were some really interesting scenarios. But without question, you know, the CRE was, you know, there were some markets where there's clearly indications that there might not be positive things on the horizon there. But are you guys seeing any and Heather, are you all seeing any real issues with your clients, or are you hearing it from the regulators in any way?
I think our clients are still doing great over here. We haven't seen that on our end yet.
Okay, so no news is good news. Okay, good. Anything else anybody has in the risk space that you want to bring up at that we've seen with our clients, or we might want to share with anybody?
Hey, one thing, Doug, I wanted to mention is I did post the link to the podcast that Rob mentioned earlier, that it's credit risk management in a potential economic downturn. And I think that's a really good podcast that Rob and I put together. So the link is shared as a response to that question, and just wanted to make sure everybody saw that.
Gotcha. Hey, one last thing I will mention. I was jotting things down as Rob was presenting. I do have more than one, not several, but more than one client where there's been some regulatory focus in the lending area, and Rob alluded to this, but around maintaining current financial information, and not, in a rising rate environment where there is an expectation that there may be some credit issues, even if they don't manifest themselves now. But current financial information, current tax returns, those types of things, and to the point, I believe they'll be in their report of exam, and but on performing loans, not related to problem loans, related to performing loans, which is kind of unusual. So anyway, that's just a tidbit out there. Okay. Well, good. Well, that was good presentation, Rob. Good information.
Thanks, Doug.
All right, poll question. And now, I don't know if this is the last one or not. Have you attended a CRI CPE webinar in the past? Hopefully the answer is yes. And we've got about 13 minutes left for me to cover AFS, which will take about 10 minutes. So be thinking about your questions. Okay. All right, AFS debt securities. So kind of similar to TDRs, when something goes away, something's got to replace it. So I think everybody's probably aware that HTM securities scope into CECL. AFS securities scope into ASC 326-30-35-7, and that is to be specific. So what ASC 326 and this specific aspect of it talks about is how you evaluate AFS securities for impairment. And so when we'll get into this list in a minute, but essentially there's some qualitative considerations. So if you have an AFS debt security that's underwater, which most everybody has at least some of, and some have a heck of a lot of it. If you're in an unrealized loss position, then you need to go through the process of evaluating the security as to whether or not it has impairment. The concept of other than temporary impairment, OTTI, it has gone away. Now, I'm going to back up and say this kind of the same way when I was talking about TDRs. Substantively, you're probably not going to get to a different place under this guidance. Substantively, meaning you're probably, if you needed to recognize impairment now, you probably would have needed to under the other, under the previous guidance. But the way you get there and the way you document that you get there is a little different. So you should identify securities in a loss position. You should look at qualitative factors, and there's a list of them on the next slide that we'll talk about. And if those qualitative factors lead you to be concerned that you have impairment, not OTTI, but impairment, then you're required to do a discounted cash flow. And this assessment, whether you're looking at the qualitative aspects or you're doing the discounted cash flow, it is done on a security by security basis. It's not on a pool. So you have to do it individually, and you have to use discounted cash flows if you have to go to the next step in the process. So ASC 326-30-55-1 through -4 discusses the types of qualitative considerations that you would need to go through. So for me, and this is similar to the TDR thing and CECL as it relates to your policy. So Heather was saying, hey, you need to update your policies. Regardless of what your practice is, your policies need to be updated, and then you need to follow the updated policies. A lot of our clients have not updated their policies, and in fact, they hadn't changed how they're doing this because it just, in the grand scheme of things, it just wasn't a priority, and quite frankly, it probably doesn't get you to a different conclusion, as I mentioned. So the first criteria that they recommend looking at is the extent to which fair value is less than amortized cost, so the severity of a loss position. Any adverse conditions specifically related to that security, again, on a security by security basis, on the industry or the geographic area, something unique to that security. Changes in the quality of the security's credit enhancement, the payment structure of the security, or changes in the security's rating. So if the bond rate, if it's downgraded, that's an indication you probably ought to look a little further and see why, and see if it rises to the level that you think you need to do a discounted cash flow. But remember, if you go through, if you identify something qualitatively that drives you to the discounted cash flow, and you do discounted cash flow and it comes out okay, you don't have impairment. So it doesn't mean you have impairment, it just means you need to go to the next step. Failure of the issuer to make scheduled payments would be an indication that there could be impairment. Remaining or a credit impairment, remaining payment terms of the security, prepayment speeds, the issuer's financial condition as known to you, and the value of the underlying collateral. So these are actually in the standard for things you should consider. It's not the only things that you can consider, and it doesn't say you have to consider them all. These are just examples of the types of things, but you want to demonstrate you have a process where you, by security, evaluate things qualitatively that might drive you to a discounted cash flow. But here's one of the big differences. The length of time the security has been in a loss position is no longer a consideration. It clearly was previously. We also had disclosures, as you all recall, about that in our notes, loss position, I think was less than 12 months, greater than 12 months, those types of things. And under this guidance, duration is not a consideration. And quite frankly, duration was the primary qualitative consideration under OTTI that most people used. So you have to move away from that. Just some thoughts around AFS debt securities and transfers. I know a lot of folks are still trying to decide what to do. Do you stay in? Do you sell some? I had a client email the other day and say, hey, I'm looking at selling these 4 securities. Can you tell me what the impact would be on my deferred tax asset and my current taxes payable, that kind of stuff. So everybody's still looking at it. You're talking to your third party, advisors and things like that. So just some high level things to think about here as you consider this. So AOCI as of the date of transfer, it doesn't go away. So if you've got one security and it's underwater $100, that amount does not go away on day one. You'd actually freeze the non-tax affected portion. You would freeze it. It remains as a contra equity account, and you amortize it or accrete it, whichever way it's going, accrete it over the remaining life of the security. So it will impact your net interest margin at some level, or your yield at some level. But the big thing is it doesn't go away day one. And I think some people misunderstood that on the front end. I think by now everybody's had enough conversations that what I just said is a known quantity. Everybody knows that. But because we don't frequently do that, everybody didn't know on the front end of this exercise. If you do that, you do need to consider that there's no future opportunity to recoup the losses. I mean, obviously, if you're in an unrealized loss position and you've gone through the process and you don't think you have any credit impairment or need to recognize any credit loss, then you think you're going to do 2 things. You're going to hold the security until that you have the, the ability and the intent to hold the security, and that it is in fact going to pay out as it's supposed to. So you're taking that off the table such that you will not be able to recoup those losses if you decide to sell or move them into HTM or whatever you might choose to do. And I guess the compounding effect here, and I think Rob alluded to this when he was talking about liquidity. If you have HTM securities, if you move AFS into HTM, then you can't readily convert those to cash if you needed to. You can, but then it would, runs the risk of tainting. If you don't do the whole portfolio, it could potentially taint the portfolio such that you would have to reclassify them all to AFS, which would obviously be a nightmare. So you need to consider that, consider liquidity in your assessment. And then lastly, as I mentioned previously, HTM securities must be evaluated for impairment under CECL. They do not fall under this guidance. AFS and HTM are now separate in that regard. So you want to update your policies, but you also want to update your practice. And again, the biggest thing is everybody's still using duration. They're using the length of time, and that is not one of the considerations going forward. And you need to clearly demonstrate that you're doing your analysis on a security by security basis. So with that, we'll pull up a poll question, and hopefully we've got I see a couple questions in the Q&A we can address. So poll question number 8. So hopefully you have answered, if you had to answer 80%, that means pretty much you had to answer 7, unless I'm doing the math wrong. This is the final polling question. Are you still there? So while everybody's looking at that, a question that came up, there's a question in here regarding being logged into the call with email for CPE credit. I'm going to defer that to our marketing group that's kind of on here. You can't see them, but they're keeping us on track. So we had a question that said, investing in fintechs has been lucrative for several FIs. What are your recommendations on navigating the risk of investing in fintechs and being successful at investing in fintechs? Just my view on that is, I mean, there's been significant regulatory activity in and around third-party partnerships. Rob alluded to that, and really one key thing he said that I think I'm going to reiterate, even though he reiterated it, is the fourth party. I mean, you can't ignore the fourth party. If there's a subcontractor involved, you got to bring in the fourth party. But I think that right now for most institutions, community institutions, if you will, that we're looking at these type of investments and partnerships, I think that they're probably a little spooked right now. I think there's less appetite for it. And I think probably, and this is just my opinion, there were a lot of institutions that probably don't have the risk appetite for it to begin with, but I think there'll be less now with the regulatory scrutiny that we've seen in the last 12-ish months and the regulatory actions that have taken place. So do I still think there's some fintech partnerships or investments that might be viable for certain institutions? Absolutely. But I do think, fintechs are kind of going through a spot right now. And I think some of the startups and, kind of seeing seeing who the players are, who the real players are, if you will, and the strong are surviving and that kind of thing. So I think everybody's kind of going to sit back and watch that play out. Next question was, how is the insurance crisis in Florida affecting risk for banks holding an interest in the property, i.e. owners unable to get required covered? I'm going to say, I don't know that I'm particularly familiar. We have 22 offices in Florida and we work with banks in Florida. I don't have a bank that's mentioned to me a concern about insurance, but I don't know. That doesn't mean that they're not concerned about it. I'm assuming you're talking about an insurance crisis due to natural disasters, hurricanes and whatnot. But otherwise I'm unfamiliar. Is anybody else familiar with that at all? I think silence is a no. Okay.
They're actually talking about flood insurance. Insurers don't want to insure there anymore because they've experienced significant amount of losses. So you could have borrowers sitting out there that have now had their insurance canceled for their homes.
Gotcha.
But we don't work in that market a lot either. I'm Alabama, so we haven't had a lot of that.
Yeah, we have a couple of banks in Florida, but we've really not gotten into that. We don't have a robust Florida-based practice. So, okay. Well, I think that's all the questions. With that, I think we're at time. We're at 1:01, so that gives us, we were in the 60 minutes. And so thanks everyone for joining us today. I hope you found it useful. Our email address is on there. Don't hesitate to reach out if there's some information we refer to that you'd like, or a link, or anything like that. If we can help in any way, please reach out to anybody on here. And thanks to the team. Great job, and talk to y'all later. Thank you.
Thanks, everybody.
Thank you.
Thank you.